bought. But if you were buying on shorter momentum, shorter term trend, shorter term momentum picking up pace, you probably would have done well regardless. Here's the thing, Albert. In the real world, if you are a trader, is taking that signal, especially if you're not looking at an index, if you're looking at an individual stock, is it a worthwhile signal to follow given the current dynamics and how swiftly trends can change? And for me, I have to say, it is an argument, right? Because there are going to be securities that are going to be very respectful of this circumstance, and then there are going to be securities that are very topsy-turvy, schizophrenic personalities who don't care about this stuff at all. So what we're going to try to do today, again, I want to elaborate before I pass on a word to my colleague here, is that you probably want to modify the moving averages and their crossovers to the time frame that you exist within. If you are a swing trader and your time frame is 1 week to a couple of months worth of a hold, it probably makes sense for you to be looking at the 20 to 50 cross versus the 50 to 200, right? If you are measuring your position time frame in 6 months plus or in years, then the 5200 cross is probably fine. Again, I would argue that the exact entries on the cross occurring or exits on the cross occurring are probably not going to be the best with the benefit of hindsight in the very short term. But over the long term, they kind of work out. Okay. So, Albert, I want to pass the mic over to you, sir. I just wanted to kind of check your gut feeling about everything that I've said, whether you agree or disagree. And I will maybe caveat emptor, my transition to you by saying it is not only important to be paying attention to the actual slopes of the moving averages themselves, or to the crossovers, to the crosses, positive or negative, but also to the relationship of where price currently is in relation to these moving averages. You naturally would expect, if something is trending higher with a lot of momentum, you would expect the shorter term moving average to be positively sloped. You would expect price to be above that shorter term moving average, and you would expect the intermediate term moving average to also be positively sloped, right? So the idea here is it's not only the crosses themselves, but where is price in relation to these moving averages at the time of you taking that signal, okay? Albert, your thoughts, sir?
Yeah, a lot of things here. And I'll start with this. The first thing is that, as Constantine said, the basic tenet of technical analysis is trends, right? We're trying to find a trend that we can basically hop on and ride, until at some point it starts to come to an end or it starts to turn. That's the goal of technical analysis. And so that second component, figuring out when that turn is or when that reversal is, that's the key to the exit, right? Or maybe a potential exit entry on a new type of trend. And that's what we're trying to do with any kind of moving average crossover. And I'm glad you mentioned the idea, Constantine, about using different time periods, because if you're trading in a shorter time period, then maybe 5,200 days isn't really going to give you a signal that's actionable. And so that's really something you have to take into consideration. And as always, with everything that we do with technical analysis, very rarely do we use one signal and make that our signal, right? Very rarely. Typically, what we're looking for is several things pointing in the same direction. We might be looking at a moving average crossover, or even to Constantine's point, what is price doing at that point, right? In addition to maybe looking at maybe an RSI or anything like that that you'd like to use. So having just one thing pointing in one direction, that might not give us exactly what it is that we're looking for. Now, on this particular chart, there's a couple things I noticed that I wanted to kind of point out. And the first is that very first death cross on the left-hand side there, It's when I look at that cross, the first thing that jumps out to me is that's a 50-day moving average, and that's a very steep, very fast move down below the 200. So what does that tell us? That means that the most recent prices had to have some massive movement to move that average because, again, we're looking at 50 days worth of information. So that means that every incremental day that comes up must be having some really big movements in order to move that 50-day average that quickly, right? You would normally see that kind of movement on maybe like a 5-day or a 10-day, maybe a 20-day. But on a 50-day to see that, that's an aggressive move. And what happens is when we take a look at where the actual price level is when you get that death cross, well, where is it? I mean, it's already gone down to the bottom and started to turn its way back up. Am I really excited about selling into that kind of a mess? I don't know. I'm probably going to look for some other indicators to make me feel comfortable about that. But I can tell you right now, just looking at that signal itself doesn't give me a lot of comfort because that's such an aggressive move. There's something going on that maybe will be beyond the limits of technical analysis. Maybe it's something that we have to think about on a more macro basis because, again, to move a 50-day like that is really pretty aggressive. So that's really the first things that come to my mind. In addition, when we talk about when watching these types of moving averages, they actually did a study and they went back to over 30 years looking at just the death cross and its value of its signal. And what they actually found was that since I think it was 92, the death cross itself was actually a better short-term bullish indicator than anything else. Now, what's interesting is now again, Cassidy, if we're taking this on the basis of the S&P 500, you can see how that might be the case, right? Because what have we done since 92? We've basically just gone straight up for the most part, right? I mean, a nice gentle angle straight up to the right. So I give you that caveat with regards to that in that study because again, you can see this chart what we've done. So it's clear to say that if you get a death cross in this type of overall environment, certainly you could expect to see some type of maybe counter indicator, right? And so that's another thing we have to keep in mind. As always, we kind of want to understand what is the overall trend, right? When in doubt, zoom out is the saying. And so if we're looking at an overall uptrending market, are we going to be as eager to take a counter trend type of signal, or are we more eager to take something that is actually going with the overall longer trend? So the same ideas that we hold for any type of technical analysis will hold for this indicator as well. So those are kind of my thoughts with regards to how I would use these things. But again, let's not just take it at face value. Let's be a little bit smarter about it and put a little more analysis behind it instead of just looking at one simple indication and deciding that's going to make our trading plan work, right?
Yeah, Albert, that's a great point. And again, this is a very important distinction when you are thinking why buying the death cross in the S&P 500 over the past 30 plus years made you money. Because the S&P 500 is not going out of business, right? The companies that are doing poorly are getting kicked out of the index, and the companies that are doing well are getting added. And so, it's kind of it's one of these circumstances that if you're not betting against the US ingenuity, against the propensity of US economic conditions to better themselves over time, then you can anticipate that the trend in the S&P 500 over the extended time frame, like a 30-year time frame, is going to be up. So if you're buying a death cross, you're probably buying a pretty decent sized drawdown. And even if you're not spotting the absolute bottom, you're doing pretty well. Now, the thing is, Albert, is that there are a lot of individual stocks that go out of business. There are a lot of individual stocks that lose 90+% of value, become, maybe go from a large cap to a medium cap to a small cap, and just trade sideways for dozens of years, right? And so this is an important caveat as well, is that for individual stocks, you have to be a lot more aggressive about the way you approach things because risk management in a single stock is much more important than risk management in a broad-based index over the long haul. Albert, here's the thing. We promised that we're going to modify some of these thoughts a little bit, right? And here's the idea. Folks, the way I look at markets, and this does not make it perfect, this does not make it right, but the way I look at markets, and I always present the market from my purview to you when I'm presenting in these classes, I use a 4 moving average system on my charts. I use simple moving averages, and my 4 moving average system that I've been using for the past 20 years is the 5, 20, 50, and 200. Depending on the type of time frame that I am trading within, right? If it's a retirement trade, that's one idea. If it's a day trade, that's a completely different beast. If it's a swing trade, that's a different thought. But we want to be speaking, right, to all of you in the audience that have different time frames. The idea of a bullish signal or a bearish signal with the cross is the same regardless of the time frame, but we just need to be aware of the fact that the shorter the moving average in terms of its data set, the more reactive it's going to be, the more recency bias it's going to have. The faster it will move with more gusto, with more magnitude, right? So Albert, what I decided to do is I went out to Fidelity.com and I said, how about we do a little bit of a study here and we look at situations that have recently turned the corner versus some of the things that might be actually getting worse or maybe potentially on the precipice of turning the corner in a bullish way. We know that the market so far under the hood in the S&P 500 so far this year has been very bifurcated. We've been talking about it very loudly. There's a lot of dispersion going on. So plenty of stocks are hitting brand new 52-week highs, and there are plenty of stocks that are off 10, 20% off of their prior 52-week highs, right? So here's the idea, Albert. I decided to shorten the time frame a little bit, and I said, let's go ahead and go to my stock research, start a brand new screener, and let's look at market capitalization stocks. And I'm doing this not because I'm trying to solicit, particular criteria for your scan, but I'm just trying to eliminate maybe some of the riffraff out there, right? For smaller non-liquid companies at the moment, and stick to, companies that you are all very well aware of. Okay. Now, it does not mean that you cannot expand the search to medium or small cap companies. That's totally your prerogative. But for the sake of this class, I'm just focusing on mega caps and large caps. So anything, kind of in excess of $53 billion here. What am I also focusing on is I want to see price of the stock XYZ in the scanner be above the 50-day simple moving average. So remember, I want the price to be preferably, if something is in an uptrend, I want the price to be preferably above the intermediate term, and I want it to be above the short term. So I'm saying, tell me, regardless of how high above the 50-day simple moving average that stock is, I want to include it in the list. I also want to include the stocks that are above their 20-day simple moving average. So I've shortened my time frame to now looking at 1 month average price, which is about 20 days, versus approximately 3 months of average price, which is approximately 50 days. I want price to be above both, and I want to see how or what we can deduce from some of the more recent historical price action where stocks have turned the corner. They were getting beaten, they were getting sold, they were being called the dogs of the Dow, the dogs of the NASDAQ, and now all of a sudden, right, they are the market leaders and they're leading the way. So is there anything that we can learn from that exercise? Let's go ahead and take a look at a company like Apple, for example. So I'm going to hop over to my chart here, and we're going to look at Apple together. The 5 is the black, the 20 is the blue, the 50 is the green, the 200 is the red. Where was it very obvious that price went from being in a downtrend to breaking the downtrend and beginning a new one? Well, based on everything that we've discussed so far, price being above the 20 blue, price being above the green 50, price being above the 200 red was right here. Now, you could have looked at this and said, Well, it gapped up on earnings. And I mean, come on, there's no chance it's going to hold a gap of that size, right? But what did it end up doing? It changed the mindset, maybe on a fundamental catalyst, of those who were longer term oriented investors. And then when it gapped up and retested the 200-day, that 200-day simple moving average acted as a level of support. Here you knew that if price is above the 20, above the 50, and above the 200, there is really no reason for you to be short this stock. And maybe it's time to get bullish. Now, did you catch the absolute bottom? No, of course not. But that's still a pretty decent sized ride. 180 to 220 in the matter of what? A month and a half, 2 months? That's pretty darn good. Now, we're going to do the same thing on Amazon, which was another one that was on there. So this is another circumstance, which is a very, very different chart, right? Remember that moving averages are trend identifiers. So what are the three types of trend that we can observe? Uptrend, downtrend, or sideways chop, right? During a sideways chop, what would you expect the moving averages to do? You expect them to be pretty darn flat. And you don't expect those moving averages to be very much respected by price. That's exactly what was going on here when Amazon was moving sideways, and it was moving sideways for about 3 months. Right? We can't argue that price of Amazon has changed dramatically, since the middle of March up until the most recent breakout here. But if we are applying the same mechanic and the same thought of the short-term moving averages, what do we want to see price do? We want to see price above the 20 and the 50. We preferably would like to see it above the 5 as well, above all three, best case scenario. And we want a range-bound horizontal resistance breakout potential. That's exactly what Amazon was giving you. When did you know that there is potential for Amazon to maybe go for a little run? Probably somewhere around here, right? When it's trying to interact with with both of those moving averages, but it's not failing to go down. Previously, when it has done that, interacted with the moving averages, got acceptance below, went substantially underneath. Same thing here, right? But this time around, it's doing something that it hasn't done in the prior 2 times. The moving averages have flattened out, and price is now holding them as a level of support. Interesting idea, right? So again, combination of price and moving average crossover systems. Now, Albert, what I'm going to do is I'm going to come back and I'm going to say, well, Constantine, it's pretty easy to maybe look at some of these, recent runners with the benefit of hindsight. How about some of the non-recent runners? And what you need to be on the lookout for if you are looking for a turn. If let's say the market breadth is going to expand and it's going to get better in the near future. So Berkshire comes up. And by the way, all I've done here is I went market capitalization, $9 billion or above. We could even, if you want to focus on large caps and mega caps to keep the whole system structured the same as we did before, that's totally fine. Percent off of the 20-day simple moving average. I want the stock to be below it. And I want it to be below the 50. So in other words, short-term trend, 1 month to about 3 month momentum, a trend is down, and momentum is very likely down as well, right? Meaning momentum is in the direction of trend, which is lower. So which stocks come up? Berkshire Hathaway, Visa, Tencent, MasterCard, Procter & Gamble, Louis Vuitton, Moet Hennessy, right? Out of France over there, the depository receipt, J&J, Home Depot, Merck, a lot of stocks that you're very likely familiar with. So let's jump over to a chart and say, let's look at a chart of Visa together. What is it doing right now? it has had a pretty rough go of as of late relative to the broader market. 290 back in March, now trading around 260. So let's call it 10, 11, 12% drawdown in the matter of a couple of months while the market is making a brand new high. What is it doing right now? It is trading underneath the 5, underneath the 20, and underneath the 50. And it came right down to the 200-day longer-term moving average, and it's holding up as a level of support, just like it did in prior touches here. So, Albert, here's the thing. Is this a buy? Well, some of you are going to, those of you who are thinking, if it held before, it must hold again. You're buying it today and setting your stop losses underneath the last couple of days worth of lows, right? Because if you're a trend follower, you wouldn't be buying it for any other reason. I don't care what you think about Visa's fundamentals. Price is the only thing that pays. So if price gets acceptance underneath all of the moving averages and it keeps making lower lows, well, then you are clearly not a technical trader, right? It's telling you that all the trends have been violated and you're buying it, and then you're probably vigorously searching online for confirmation bias and someone to agree with you, right? But truly, if this thing is going to get out of its funk, I would argue that it is probably still in play, even though the range is pretty darn big. You could say, I'm buying it today with a stop loss underneath the most couple of days worth of lows because I don't want that 200-day simple moving average to be violated. But you can wait for price acceptance above the 200, above the 5, above the 20, and above the 50 on the breakout of this downtrend and acceptance here for a much more positive sort of risk reward potential type setup, right? So this is a type of stock that you would add to your watch list and say, I'll watch it for now very closely, and I'll be cognizant and aware if and when price gets above 275 to 278, that might be a very good opportunity longer term with the expectation that the stock might make brand new highs at some point. How about Home Depot? Similar story? I would argue absolutely. I mean, where is it right now? Has it had a rough time as of late? For sure it has. What is it doing? It's not really being respectful of these trend lines because price hasn't really changed. What was the first time it traded 330? August of 23. We're now in July of 23 and it's the same price. So think about price in this context. It's been higher, got a lot of bulls very happy. It was a lot lower, got a lot of bears very excited, but it really has been dead money for a year. In a high inflation environment, in a 5.5% interest rate environment per annum. So this idea here is being bullish above when the stock price gets accepted above all of the moving averages gives you the potential to be bullish above, neutral bearish below, right? In my opinion. And again, if price does not hold and get back above these moving averages, then what are you really buying? You're buying the hope that what used to be support continues to be support. If that level on the downside 3.25 goes, you better have a risk management tactic in place. But you're very likely, if you're a trend follower, you better wait until price gets above 345 to get more of a beneficial pot odds risk reward in a bullish sense. Okay, Albert, your thoughts here, sir?
Yeah, another thing I love about looking at moving averages is I tend to also look at the compression of the moving averages. In other words, how close are they to each other, right? And what's the spread between the farthest one on the upside and the farthest one on the downside? If that is a historically tight compression, it's a lot like a Bollinger Band almost, right? And we can think about it as periods of consolidation. So as you can see right now, in this particular chart, yeah, there's a huge compression between all of these moving averages, which means there's not a huge trend at this point, right? It's a point in time where things are consolidating and it's trying to find its way and figure out what's happening. Look at the massive uptrend previously and look at the spread between all these moving averages, right? It's widening out because in the short term, this thing is pulling away and moving up. Now recently, of course, they're all compressed, meaning that this hasn't really found a level of a breakout, right? So there's some consolidation going on here right now. The question becomes, what happens after that consolidation? That's what we're trying to figure out, right? But keep in mind, whenever we're doing technical analysis, no matter what it is that we're using, moving averages, RSIs, anything, it's not predictive, right? It's not going to tell us the magic direction it's heading out to. What it can give us is the opportunity to prepare ourselves for when we get that confirmation, much like Constantine was saying on that Visa chart. When we get that confirmation, then we can act, and we can act with a bit more confidence because we've given it time to make its move. We've got some indications that maybe it's moving in the right direction, and then we can go ahead and make our positions there. No, we're not going to catch the bottom. We're not going to catch the top, probably. In fact, Constantine, I think the only time I ever caught the bottom on something was on a sale, not on a buy, So the point is that we're not going to get the entire move, most likely. So it's important to try to get the majority of the move, but let's make sure we're doing it in a smart way. And so I think moving averages are a fantastic way to, kind of position ourselves and be ready to move when everything is pointing in the right direction.
Albert, a few additional things just to put in your pocket, right? So one of the indicators that might keep you out of trouble, let's say that you're observing something that is substantially extended, right, over its short and intermediate term moving averages, like NVIDIA. One of the indicators that I would suggest utilizing is something that is known as the percentage price oscillator. It's actually based off of exponential moving averages, but trust me on this one. An exponential 200-day versus a simple 200-day is not going to have a massive difference between the two, okay? So what I do is I come into this PPO and I change the first period of 1. So in other words, where is the current price relative to a moving average in observance? And I look at this indicator historically to say, and by the way, those of you who've been following me for a while, right? Like we were looking at NVIDIA 80% above its exponential 200 and saying, we know that trees don't grow to the sky. We know that the last time it got it this extended above its very long term, it's seen a pretty decent sized pullback. Right? If you use this indicator in a similar fashion, you probably stayed out of trouble, right? You stayed away from having FOMO, fear of missing out. This is something that is a very useful thing to look at on the longer time frames, regardless of where the stock currently is in price, because it's constantly looking at the percentage differential between the current price and an exponential moving average of the longer time frame or whatever you're comparing it to. Okay, so this is the type of thing that could keep you out of trouble. Now, are there some Fidelity tools that could be helpful? I mean, I think so, but you got to do a lot of work on your own as well. So one of those things is the real-time analytics. I know that we're over time by a few minutes, but if you would just allot me 2 or 3 more minutes, I will promise you we will finish up and I'll let you go. The real-time analytics tool can be structured to look for simple moving average crossovers. So you can type in or check off the SMA crossover into that methodology and then tell it, what do you want to be applying it to? So the S&P 500 as an index, and it's going to be in real time looking for crosses. GL, simple moving average crossover, 20 simple below the 50. SYF, Synchrony Financial, the other way around, 20 simple moving above the 50. This will be done in real time. And by the way, if I keep scrolling down, you would see that there are plenty of expired signals as well that would also show up. So some of the stuff that showed up from days prior. You could also do this thing to the application on stocks that are in your watch list only, or to the stocks that are in your positions and watch list only. So this tool could help you look for those crossovers in real time. That will give you a real-time notification here. You can pop in here and say, you know, I'm looking at this XLU. It happened today at 9:30, 20 below the 50. Let me go ahead and chart this thing. And is it in fact occurring? And the answer is absolutely it is, right? Maybe the colors are kind of trash. If you have you know, a black background, it would probably be the colors and the theme would be better. But you understand the point here, right? The 20 is crossing below the 50, and that's a worrisome signal. Albert, last words to you, sir. This was great.
Yeah, it's amazing how fast a half hour goes, right? It just flies by, but we could probably spend another half hour or 2 hours talking about this stuff. But bottom line is, the goal here was not to say, hey, you got to get out there and start looking for these moving average crossovers. The goal here was to explain the theory behind what these are looking for, this golden cross and this death cross, how you might be able to apply it to actually what you're doing. Maybe 50, 200 doesn't really apply, but you can certainly see how we change that around. And more importantly, how you can use these types of signals, whether it be a 50 to 200, 20 to 50, or 10 to 20, how you can use them in your actual trading and what those signals might be telling us, and give us an opportunity to maybe make a little more informed decision, or at least an opportunity to have a trading plan that might be a little more tilted to our advantage, as opposed to just trying to throw some darts at a dartboard kind of thing, right? So hopefully it's been useful for you. Constantine, it's always a pleasure to share the screen with you. I hope we can do this more often. But I hope everyone has a great rest of their day. Happy 4th of July to everyone. Let's come back with all of our fingers, and I hope everybody has a great rest of their day. Take care.
Take care, everybody.